Hi, everyone, and welcome back to Money Girl, a podcast that helps you master your money so you can live rich and love the journey. My name is Laura Adams. I'm a personal finance expert and author based in Silicon Valley. You can learn more about me at lauradadams.com. And while you're there, check out my tools page on the site. I've included resources that I recommend for just about every area of your financial life, like saving, investing, building credit, managing money, and improving your productivity. Also, before we get started, a big thanks to everyone who submitted 5-star reviews of the show in iTunes. You guys are amazing. I read every one of your comments and really appreciate the feedback. If you enjoy the show, please take the time to submit a quick review. It helps the show stay visible in iTunes so more people can find us and stay inspired to live their best financial lives. Today's topic is about reverse mortgages. Even though these products have been around for almost 3 decades, many people still are not familiar with them and really don't understand how they work. So in this show, I want to explain what a reverse mortgage is, the different types you can get, who can have one, and how much they pay. Plus, I'm going to outline the major pros and cons to consider before you or someone you know gets a reverse mortgage. This is a question that came in recently from a Money Girl podcast listener named Steve B. So even if you are not in the market for a reverse mortgage, I hope you'll stick with me because you might have a family member like a parent or an aunt or uncle who is interested in a reverse mortgage, and maybe you can help them make a smart decision. This is episode number 435 called Pros and Cons of Getting a Reverse Mortgage. Let's start out by defining exactly what a reverse mortgage is, then we'll talk about the types and get into pros and cons. A reverse mortgage is a home loan that allows you to convert a portion of your equity into cash without having to make any payments. It's actually a pretty innovative product. To get one, you must be at least 62 years old. You've got to own and occupy your home and have at least some amount of equity in it. If you're not familiar with the concept of equity, it's simply the difference between your home's appraised market value and how much you owe on it. For instance, let's say your home is worth $250,000. If your mortgage balance is $100,000, then you have $150,000 in equity, which equals 60% of the value. The main difference between a reverse mortgage and a regular mortgage or home equity loan is that the lender pays you instead of you paying a lender. That's the reverse part. It's an advance on the equity you've already built up in your home. To qualify, you typically need at least 40% equity, and if you already have a mortgage, you also need enough equity to pay it off using the loan proceeds, so the reverse mortgage is the only debt on your home. Since you don't have to make payments, you may be wondering how a reverse mortgage is paid off. Well, the amount that you owe grows as interest on the loan accumulates over time. And just like a regular mortgage, you eventually have to pay it back with interest. You or your heirs will have to settle up with a reverse mortgage lender when you move out of the home or die, typically by selling the property. Heirs have a minimum of 6 months to satisfy the debt, but they can also request a 90-day extension if they need some more time. If a reverse mortgage is not paid off by that time, the lender could begin foreclosure. But here's the deal. Your heirs, they're not legally responsible for your reverse mortgage debt. So if the house sells for less than what you owe, the lender takes a loss, not you or your heirs. And if your home sells for more than what you owe, any remaining equity belongs to you, your heirs, or your estate. And by the way, I did a show called The Truth About Debt and Death, which is episode number 425. It gives you the facts about what happens after a family member dies and can hopefully put your mind at ease about it if it's something that you're worried about. There are 3 main types of reverse mortgages that you can choose from. The first one I'll cover is the most popular. It's called the Home Equity Conversion Mortgage, or HECM for short. The HECM is the most popular mortgage because it's backed by the Federal Housing Administration, or FHA. It gives you multiple payment options and allows you to use the money for anything you want. If you choose an adjustable rate HECM, you can be paid in a variety of ways. You can get a single lump sum payout. You can get fixed amounts over a specific period of time. Fixed amounts as long as you live in your home, You can even get a line of credit that allows you to tap any amount of funds at any time until you've used up your available credit line. Or you can get a combination of fixed payments and a credit line. Now, a fixed rate HECM offers a lump sum payment only, so they don't have quite as much flexibility as the adjustable product. The total amount you can borrow on a reverse mortgage is called the principal limit. It's calculated based on factors such as your age, home equity, and interest rate, but it's capped at $625,500 as of 2016. The amount you can borrow is typically in the range of 50 to 60% of your equity, but it could be more or less depending on your situation. As interest rates rise, homeowners qualify for less money. However, older homeowners can typically borrow more since having a shorter life expectancy makes you less risky to a reverse mortgage lender. One unique feature of an HECM is that you have to complete financial counseling with an independent government-approved agency in order to apply. The counselor must explain the loan's costs, your obligations for repayment, and possible alternatives to tap your home equity. There is no income or credit requirement to be approved for a reverse mortgage. However, lenders do assess your overall financial situation. They want to make sure that you're willing and able to maintain your home after the loan is funded. The second type of reverse mortgage is called a proprietary reverse mortgage. It's offered by private companies, and these loans make up a small slice of the reverse mortgage market. But I want you to know about them because they do offer unique features because the federal government does not insure them. In other words, they don't come with as many restrictions as HECM products do. For instance, if your home is worth more than the government's lending limit that I mentioned of $625,500, you can get a much larger loan. That's why proprietary products are also called jumbo reverse mortgages. Similar to an HECM, you can take funds as a lump sum or as a line of credit and spend them any way you like. But unlike an HECM, proprietary reverse mortgages don't come with upfront or monthly mortgage insurance premiums, but they may come with higher interest rates. Another big difference is that the lender can, but doesn't have to require you to get mortgage counseling. And the last type is a single-purpose reverse mortgage. These are not widely available, but they are the least expensive. It's called a single-purpose mortgage because it can only be used for a specific lender-approved reason, such as making home repairs or paying property taxes. Single-purpose reverse mortgages may be offered by local and state government agencies and nonprofits. They often go by another name, such as a property tax deferral program, and may be limited to low to moderate income homeowners. Now that you understand what a reverse mortgage is, I want to summarize the benefits of the HECM product only since it's the most popular type. Here are 5 main pros to consider before getting a reverse mortgage. Pro number 1. There are no restrictions on how you spend reverse mortgage money. As I previously mentioned, getting a reverse mortgage means that you can quickly tap the equity in your home and spend it any way you like. That's a lifesaver if you're cash poor, but equity rich and need to supplement your retirement income to meet everyday living expenses and bills. Even if you have plenty of income, you could use a reverse mortgage to pay off a first or second mortgage so you don't have to make monthly payments anymore. That helps cut costs so you can stretch your income every month. Or you could use the money to take a dream vacation, make home improvements, buy a second home, a boat, or to start a business. No matter how you use the money from a reverse mortgage, it's a great source of tax-free income after you reach age 62. Pro number 2. You don't need income to qualify for a reverse mortgage. One of the problems with getting a regular mortgage or home equity loan when you're in retirement is that you may not have enough income to qualify, even if you have plenty of home equity. But with a reverse mortgage, you can qualify even if you have little or no income. That means you don't have to sell your home to get your equity out of it. You can keep your home, maintain your lifestyle, and take income from the equity you've accumulated. Pro number 3. You can take money from a reverse mortgage in a variety of ways. As I mentioned, depending on the reverse mortgage product you choose, you can access your home equity in different ways. Getting an adjustable rate product that comes with a line of credit really gives you the most flexibility. You can tap it if you need the money for any reason, or you can leave it alone if you don't. Pro number 4, a reverse mortgage line of credit can grow over time. Another huge advantage with a reverse mortgage credit line is that your unused balance actually grows at the current interest rate. That means you could end up with more cash over time than when you originally got the credit line. This is how a reverse mortgage can be part of a smart retirement plan. For instance, let's say you don't need to tap your equity at age 62, but you take out an HECM line of credit anyway. If an unexpected tragedy occurs, like getting Alzheimer's, needed an assisted living facility, or having expensive home repair bills, you'll have a growing balance to leverage if you need it. You may not need it, but knowing it's there can give you terrific peace of mind. Pro number 5, you can never owe more for a reverse mortgage than the value of your home. Regardless of how much you borrow, reverse mortgages are designed so you can never owe more than what your home is worth. That protects you in case your property value declines. As I previously mentioned, if you or your estate cannot sell your home for enough to pay off your reverse mortgage balance, the lender takes a loss, not you. Now, let's talk about the cons of getting a reverse mortgage through the HECM program. Okay, back to our cons. Con number 1, reverse mortgages come with higher than average costs. The major downside of getting a reverse mortgage is that they do come with fees, closing costs, and interest rates that are higher than for traditional mortgages or home equity loans. Because your ability to get a reverse mortgage is not based on traditional factors like income and credit score, lenders offset the unique risks of the loan by charging you higher fees. But the longer you have a reverse mortgage, the less it costs you over the long run. So, if you just need money for a short period of time, or you plan to sell your home after just a few years, you'll probably come out ahead by getting a regular home equity loan or line of credit instead of a reverse mortgage. But as I previously mentioned, those types of traditional loans require you to have sufficient income, credit, and to make monthly payments. Con number 2, you're still responsible for all of your home's expenses. With any type of reverse mortgage, you keep the title to your home. That means that you're still responsible for maintaining it, keeping it insured, and paying the property taxes. If you don't comply, you could be required to repay your reverse mortgage early. But the good news is that you can pay for these expenses using the money you get from the loan or line of credit if you have enough equity. Con number 3, you or your heirs have to eventually repay a reverse mortgage. As I previously mentioned, if you can't stay in your home, you have to begin repaying the debt. Now, if you relocate or go into a medical facility due to an illness, you have 12 months before you have to pay back the balance. But this could be a time in your life when money is tight already. In some situations, a surviving spouse who did not sign a reverse mortgage loan, maybe because he or she was younger than 62 at the time, they may be able to stay in the home. However, your spouse would not be allowed to take any money from the reverse mortgage, and they'd also be responsible for maintaining it and paying insurance and property taxes. Remember that spending any amount of equity in your home reduces the value of your estate, which leaves less for your heirs. So, if leaving a financial legacy is important to you, consider other ways to accomplish that goal, such as purchasing life insurance. Con number 4, you won't be able to deduct home mortgage interest. A big benefit of a traditional mortgage is the home mortgage interest deduction. That allows you to deduct the interest you pay from your taxable income, which reduces the amount of tax you owe. But you can't deduct interest for a reverse mortgage because you don't make principal or interest payments on the loan until it's paid off. At that time, you can take the deduction if you're still alive. Con number 5, getting extra income affects your ability for certain benefits. Getting money from a reverse mortgage could affect your eligibility for federal or state benefits that are based on assets. For instance, if you believe you might need to rely on Medicaid for long-term care, having a reverse mortgage might substantially delay when you can qualify. But getting income from a reverse mortgage does not affect regular benefits like Social Security or Medicare in any way. A reverse mortgage can be a quick way to turn your home equity into cash without having to sell the property, give up ownership, or make monthly payments. When used wisely, it can be a valuable financial planning tool. It can also be a solution for cash-strapped retirees or just icing on the cake for those who want to upgrade their lifestyles in retirement. But a reverse mortgage is not for everyone, so you really need to weigh all the pros and cons very carefully. Also, compare interest rates and fees of different types of loans and consider alternatives to tap your equity, such as traditional home equity lines of credit or a home equity loan. Again, a big thanks to Steve B., who sent in the question about reverse mortgages. And to keep the money conversation going, join my private Facebook group called Dominate Your Dollars. It's filled with some amazing people who are really helping others, asking good questions, and reaching for and accomplishing big financial goals, just like you. To request your invitation, visit Dominate Your Dollars on Facebook, or you can send me a text message for immediate access. Just text dollars to the number 33444. I hope to see you in the group. That's all for now. I'll talk to you next week, courtesy of Money Girl, your guide to a richer life.